sense suggests that any physical support for money has to be uniform, so money can serve as a unit of account, its second role. And the physical support must be durable and difficult to alter, so money can be a store of value, its third role. An essential feature to overcome the problem of non-coincidence of wants. It is easy to see that these three roles of money are inseparable and essential for money to be able to serve the additional roles of facilitating exchange. Once an adequate medium that can serve as money has been identified, the obvious first economic question that arises is, how much money is needed for the adequate operation of a market economy? Monetary economics, so far, has not been able to provide a satisfactory answer to this question. Some prominent commentators, even today, argue that whatever stock of gold we have is more than adequate, and all the paper money that has been issued since the abolition of the gold standard is undermining the stability of our market economies. At the other end of the spectrum is a view that has become popular in recent years, namely that since it costs essentially nothing to print, or electronically wire, money, there is no limit to how much money should be printed. Pursuing the analogy of fiat money with equity further, we thought that new principles based on corporate finance could be developed and applied to this question. Any company can redenominate its shares via a stock split or reverse stock split, or issue new shares via a seasoned equity offering, essentially for free. But this does not lead companies to issue an infinite amount of shares, for the simple reason that new equity issuance or a stock split does not equate with new value creation. And if there is no new value creation, indeed if there is value destruction, in the process of issuing new shares, then the inevitable consequence is that each share is worth less. Companies, of course, understand this, and, acting in the interest of their shareholders, they issue new shares only if this results in some value creation. Here we have a basic principle of corporate finance that can be applied to monetary economics to better understand what drives money creation. As stimulating and promising as these ideas seemed to us, we had no inkling of how they might be perceived by other economists, by our peers in academia who specialize in finance and monetary economics, or in the wider business and finance communities. We first presented our new analytical framework in a keynote address at the annual meeting of the American Finance Association in January 2016, and received generally positive reviews. But this is almost always the case on these, mostly celebratory, occasions. As happy as we were with the outcome, we could not infer too much from these first responses. Much more significant in our eyes were the responses at a luncheon with Chen Yuan, the former chairman of the China Development Bank, CDB, and other top Chinese policymakers in a beautiful courtyard in Beijing in July 2017. The topic of the luncheon was development finance and the important role of infrastructure investment and urbanization. The CDB, under the leadership of Chen Yuan, of course, played a major role in originating and financing infrastructure investment and urbanization in China and elsewhere in the world. At some point during the luncheon, the discussion turned to the role of the People's Bank of China, PBC, in supporting the financing of the enormous expansion of the CDB finance sheet, and this brought us to the topic of money and money creation. Having briefly explained our main premise of fiat money as equity, and pointed out that the effect of increasing money supply depends on how money enters the system, what money buys, we went on to argue that our framework was useful to understand the effects of the money creation of the PBC and CDB to finance infrastructure investment. To our surprise, our line of thinking was met with genuine enthusiasm by everyone around the table and led to a fascinating discussion on possible policy implications. If that was not encouraging enough, 1 month later, on August 3rd, 2017, The Economist reviewed our first working paper, NBER Working Paper 237.